Today's show is sponsored by Essentia Analytics, an award-winning fintech company that provides AI-driven behavioral analytics services to professional investors and allocators of capital. Essentia works with leading active equity investment teams to measure, improve, and promote their decision-making skill, and helps asset owners and allocators assess portfolio managers based on demonstrated investment skill, not just past performance. To learn more about their revolutionary approach to unlocking behavioral alpha in active equity management, visit essentia-analytics.com. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is John Zolidis, the president and founder of Quo Vadis Capital. John is a consumer and retail specialist who manages money for clients and, harkening back to his sell-side days, offers single stock research to professional investors. Given all of the secular and cyclical factors that have impacted retail companies over the last decade, I was really looking forward to speaking with John about the unique return on capital lens that he approaches brick and mortar companies with, how he structures an investment portfolio, what people commonly get wrong about retail and restaurant stocks, what a retail compounder looks like in the early stages, and the lasting impact of the shift to e-comm and of COVID on the retail sector. And without any further ado, here's my conversation with John Zolidis of Quo Vadis Capital. John, for people who are not familiar with you and your firm, I think it would be helpful to start with the business model and for you to discuss how you incorporate a research product with money management.
Hi, Ben. Thank you for having me on your podcast. So Quo Vadis Capital, I founded it in 2017, and there were two ideas. So first, I wanted to continue to do research on a more kind of outside of the Wall Street normal approach for institutional investors, hedge fund managers, pension fund managers, mutual fund managers. And then secondly, I set it up as a registered investment advisor so that I could manage money as well on the side. So I've got separately managed accounts for individuals, and then I have a research service product that I have for professional investors.
And maybe you can describe the research product a little bit just to give people a flavor for what the kind of the value prop that you think you add to professional investors.
So it's an idea service. So I'm making long and short calls on companies within my area of expertise, which is retail and restaurants, utilizing a proprietary approach that I've developed over 2+ decades. And I'm really trying to determine, when the consensus expectations for a company are incorrect. And the idea is to maintain that research in a kind of semi-private way for a small group of investors without affecting the embedded expectations in the equity value. So therefore, we can take advantage of when companies report upside to earnings or downside to earnings and profit from those dislocations in the stock. So I've got some short-term oriented calls based on earnings revisions, and I've got longer-term oriented calls based on finding attractive high ROIC compounders that may be overlooked by the market. And I think what I try to do is have present my product in a investment deck case, so sort of the way that the buy side communicates to each other. So my objective is generally to have one of those decks per month, and then to have follow-up notes on a weekly or daily basis, depending on what news is coming, to kind of comment on what is new or changed or which companies I've talked to along the way.
And for someone who's interested in investing in Quo Vadis Capital, how does the research product inform or complement the investment process in your mind?
So the with the separately managed accounts, I'm trying to find long-term compounders, companies that can grow, that are superior companies. I try to buy them at a discount and then hold them as long as the investment case remains intact. So it's a very tax efficient strategy. So in the 5+ years I've been running my portfolio, probably the core stocks haven't changed at all. So I'm trying to stick with companies that I really believe in, high quality businesses, again, buy them at a discount. And the synergy is twofold. One, you have the advantage of I already have 25 years experience looking at these kind of businesses, so I'm able to select some really excellent companies based on maybe following them for a decade or 2 decades. So I have a high degree of confidence in the business, the management team, and where those companies are positioned. And then there's a second component, which is when I'm looking for new ideas. So it's wonderful to own Home Depot or Costco, but even more wonderful would be to find the next Home Depot or Costco. And so how do you do that? And so I have a process based on many years of looking at these companies in great detail to try to differentiate between the businesses that might develop into these long-term home runs and those that are kind of overpriced or have problems. So I'm looking for those constantly. It's very hard to find them. I recently did a lecture at Columbia Business School where I tried to define how many ideas like that you could potentially have per year. And my conclusion was maybe 4, if you're lucky, that you can really analyze. So you just don't come across high quality companies that can grow for the long term where you can do the work and really understand them that frequently. So as a client, a potential client in the separately managed accounts, my job is to find those things, and the client's benefit is to get a guy who's really doing all the work, that brings a process and a lot of experience to bear to try to identify potentially these really fantastic businesses we can own over the long term.
And you've referenced the proprietary process that you honed over the last 25 years. Without giving away the secret sauce, maybe you could just explain the differentiation or the different perspective that you bring on these companies that helps you identify maybe those 4 ideas a year that are actually worth spending time on.
Well, I don't think it would be possible to give away the secret sauce, but I actually can explain all of it. I don't think there's any risk of others scooping it up, because the problem is it's really hard. And so there's no shortcut. The idea is based on using unit level economics. And by say, when I mean hard, I don't mean intellectually hard, like difficult to understand. What I mean is kind of tedious and challenging to actually execute. Having context helps, but I don't think I'm very comfortable talking about it. I don't feel like I'm going to give away something that others are going to easily adopt. But essentially what I look for are companies that can be broken into smaller pieces. And then I focus on unit level economics, which is to say, I try to calculate for each business at its core, how profitable is each retail store, is each restaurant, is each fitness gym, is each WeWork location, is each hotel. And then we look at those on a cohort basis. So we say, okay, well, Shake Shack opened 40 locations in the past year. How are Shake Shack's locations open last year compared to the year before? What's the outlook for next year? We do a trend analysis, and we use that, in short, as a forecasting tool. So we try to identify trends within unit level economics in these businesses as they grow. And that tells us if the business is improving, deteriorating, and then what are the implications for the long-term equity value and value creation of the business. And we base our investment case based on these kind of trends that we see underlying in the company. And this is completely different from the way most of Wall Street invests right now, which is to use data to take top-down analysis of how businesses are actually performing on a revenue basis and try to get in front of reported trends in results. So my analysis, which is very bottoms up, very granular, it helps to really understand, or for me anyway, what's driving the profitability of the business, and then therefore to justify what we should pay for it and continue to be invested, or whether we should get out of the stock.
So if I had to summarize a little bit, taking very easy to calculate metrics such as sales per store or EBITDA per store is too blunt an instrument to really understand what's going on with the different cohorts and the different kind of vintages of new stores. And that's and kind of like following those trends really gives you a much more granular understanding of how the business is performing.
Yeah, so let's develop that a little bit. Okay, so you mentioned revenue per store, and so that is something that I think a lot of analysts, especially sector analysts, look at. They look at AUVs, average unit volumes for restaurants. They look at sales per square foot. So I start with those metrics as well, and then I estimate the store level cash flow for each unit or each cohort of units. Now, it's a little easier in the restaurant case because they tend to give you the restaurant level margin, RLM. Retailers tend not to provide a store level margin. So I have a methodology for estimating what the store level margin is, how much cash is coming out of the box. Then you have to look at the capital that's put in each box. And so that's updated quarterly or annually based on what the company says, what I can extract from the balance sheet. I also take the lease data from the filings, or depending on what's available, and calculate those as if they're a debt instrument. So we look at lease adjusted return on invested capital, and we calculate each of these items on a quarterly basis, rolling it up to a trailing 12-month calculation. And so that gives you your trend, this trailing 12-month calculation for both the average or the total company, units, stores, fitness gyms, whatever they might be. And then separate from that are the most recently opened cohort. And when you calculate the return on invested capital at that piece, we use another term for that, return on incremental invested capital. And so that's where it gets interesting, is to try to find changes in incremental invested capital, which is to say, what's happening with the most recent dollar that a company is putting into its business? How does that compare to the dollars it deployed in the prior year and the year before that? And what does that imply about the company's future profitability, return profile, and valuation and growth? And one of the insights this is based on is the idea that same-store sales is the metric that is the most frequently analyzed by investors. So it's very difficult to get an edge on same-store sales. But by definition, if everyone's focused on same-store sales, they're paying less attention to what's happening at the newer units. Furthermore, companies don't report a new unit productivity number. This is a kind of calculation that you have to do. Some companies try to obscure it. They may talk about it. But when you're an investor, when you're looking for an edge, one way to approach it is like, how can I get an actual metric that has a material impact on a company's future performance that not everybody is paying attention to? And that's where this all kind of has germinated and has been developed by us over the years to create this forecasting tool.
And if someone is an industry specialist or even a generalist who's not going this deep in terms of understanding the incremental returns on capital, what kind of misunderstandings or mistakes can be made in drawing conclusions from data that is more maybe just solely focused on same-store sales?
So you can have a case where a business is performing quite well, and reporting same-store sales increases, but management has changed the format of the box, the size of the box they're going after. They're changing into a new market. They have saturated the demand, and so the same-store sales might be reporting nice increases, and simultaneously you could be seeing weakness in the newer stores. So I find that to be a leading indicator, sometimes of something that's going wrong. So I feel like you can get fooled by same-store sales. So if you're not doing the second piece of it, you might draw the wrong conclusion about how business is performing. Um, if we take the other side of that, you might say, well, hey, this business is not reporting in very large same-store sales increases, but maybe the new units open up at very high levels of productivity. They're getting really great returns. And so in that scenario, as an equity holder, you might say, well, I don't really care if they only report 1 to 2% comps, because the return profile of this business is so attractive and so consistent, and the market will pay a lower multiple because they care more about same-store sales than ROIC. And then you can take advantage of that on the long side.
You talk about being a long-term oriented investor and looking for compounders. I would assume that with so many firms focusing on specifically quarterly same-store sales, does that volatility create opportunities for longer-term oriented investors in your history?
I mean, of course. So let's take a specific example. So Five Below. So Five Below, it's been public for about 10 years. I followed it since it's gone public. And I recently did an analysis where I looked at the 10-year history of the business. So the revenues and the store base have grown at a high teens CAGR, and the earnings and EBITDA have grown slightly faster than that. But the interesting part was that the sales per average store have only CAGRed at 2%. So what that means is that all of the growth has been from new unit openings, or not all of it, but the vast majority of the growth. Now, if we ask ourselves what drives the stock and what do investors spend their time doing, I think they spend 80-90% of their time trying to figure out if same-store sales are going to be up 2% or they're going to be up 3%. And the reality is that it's not particularly relevant to the value creation of this business over time. And the stock's incredibly volatile, to your earlier point, around these small fluctuations in same-store sales, but you're really missing the point. Like, what is going to drive earnings and cash flow and growth and equity value? It's the unit growth. So that's really the thing that you should be paying attention to. How are those new units coming out of the ground? What's the productivity of them? Is the investment that's required to open the stores, is that changing? Is there a profile change on the margin side? And so I feel like if you are able to look past the volatility created by same-store sales, and Wall Street's focused on that, to identifying what's the true value creation, you can be just much more sanguine about all of what's happening, and just stick with your position. And obviously you can buy more if it goes down. But I think ideally, if you can just own an awesome company over a really long period, that's just a much better outcome, and it's a lower anxiety level existence for you as an investor.
I think we've done a good job of establishing where there's a potential edge in the strategy. So let's dive into what the strategy looks like specifically. Maybe you can talk about the portfolio construction regarding geography, number of names, market cap focus. Maybe just give an overview of what all of this work does to inform portfolio construction.
Well, I mean, in the separately managed accounts that I look for, I run a concentrated book, so less than 20 positions. And I'm trying to find high margin, high quality businesses that can grow over time. I do want to have some construction to it, as you point out, so not to be completely in the having the same factors that from an economic standpoint, because I'm a bottoms up guy, not a top down guy. But generally, all of the businesses I own, I want to have these shared ROIC, high ROIC, cash flow, margin characteristics. So what I want to find is like some in different spaces so that they're not all leveraged to exactly the same metric. So if you want to own Costco, which is a higher income business, but a lot of food, and Home Depot, which is obviously attached to the housing cycle, they're not going to move in lockstep. If you want to own something like, I'll talk about Airbnb, which is not a retail or restaurant, but I think has one of the most attractive financial models I've ever seen for any business. I want to buy businesses like that can grow, that are in the right trend area. But I don't want to be 100% in tech because it's very volatile and it moves around on interest rates and can give you a headache in those kind of scenarios. So the portfolio construction for managed accounts is high quality companies, own them long term, not have everything in the same sector, but they need to be understandable to me. So I'm not buying things that are outside my core expertise or that I feel that are too technical in terms of how their business works or their success criteria over time.
And does that lead you to any specific geographies? Is it just US and Canada? Do we look outside? And then maybe it sounds like you're market cap agnostic, like you'll own something big and something small. Maybe just comment on that a little bit.
So I do look at things outside the US. I spend a lot of time outside the US. I'm going to China once per year. I'm very interested in China, for example. But the reality is that the best market for innovation and companies is the US. So total global equity market is somewhere between 40 and 45% just the US. So it's the vast majority of all equities, not the majority, it's almost half of all the equity value in the globe is from US companies. Europe, that has a lot of demographic challenges. Certainly you can find great companies in Europe, but it's easier to find them in the US. Just the market is better. The challenge is it's a mature market. So you also want to find things that have the ability to grow a lot. That's why China is attractive. The approach I've had for China for my managed accounts is to invest in US companies that can grow in China. So you kind of get in there, but you still have US governance, you still have US brands, you're still a majority US business, but you're benefiting from the promise that China has. India is super interesting right now, but it's very difficult as an individual investor to buy Indian stocks. I'm not a big fan of just buying ETFs or market ETFs, so I'm just waiting for that to open up a bit. From a market cap standpoint, I mean, I would love to own only smaller companies, but it's hard to find small companies that you can believe in that have the same potential. If I look at a company like Google or Meta, Facebook, I mean, these are amazing businesses that I actually think are not that expensive. If I look at Microsoft, it's easy for me to understand why that's an attractive company. They control the world's operating systems on computers, and they have a huge cloud business on top of that. I can very easily understand the cash flow generation of the business, its market position, its margin structure. I don't think I need to be a tech expert to perceive why Microsoft is an excellent business. But I'm also still I'm more excited if I can find something that's small and interesting. One of the stocks that we own in our book is Yeti. So that's a branded maker of consumer products. It's been public for maybe 4 or 5 years. They've got the drinkware, they've got the coolers, but there's also potential for that brand to expand into other areas. And so I look for companies like that have a great brand, have great brand equity, have a culture of innovation that are earlier in their growth curve so that maybe they can be much larger than they are at some point in the future. And so I want to own those if I can buy them, if the financials are attractive and I can buy them at an attractive valuation.
So we've talked a lot about what you look for in longer term investments. I know you also have sell ratings on some of the companies in your research universe. Do you actively short as well? Is that part of the separately managed account strategy, or are these mostly long only accounts?
So the separately managed account strategy is a long only strategy. Um, Shorting, as I'm sure you know, is difficult. There's more ways to lose, but I'm naturally a skeptical person. Before I went into finance, I was a philosophy PhD student, and so I'm just oriented to be very questioning of stories and narratives, and I can't really help myself but to try to find things that are wrong with stocks that everyone seems to love. So on my research service side, my clients are looking for that. They're looking for me to poke holes in a story that is getting a really high multiple, but from a managed account standpoint, that adds a risk element. I have put a few shorts in various client accounts when clients have specifically asked for that, but it's not part of the kind of alpha generation strategy, if you will.
And I've always been curious about this because I feel like, you know, retail and consumer companies create just all kinds of like diverging opinions, and people have very strong opinions about, valuations and growth and stuff like that. What makes for a good short in retail in your kind of in your tenure in the space?
Okay, so the first comment I would make is the number one criteria you should have for a short is that earnings expectations are completely wrong. So if a company is supposed to earn $3, but you think they're going to earn $1, it's going down. It's unlikely that that stock's going to go up. So your work when you approach something should be to try to debunk the analyst estimates. Like, how can this outcome from a financial standpoint be completely different from what the street is pricing into the stock? So now that's kind of like the end, right? That's the end point, is that you've come to this conclusion that the estimates are completely wrong. Now, so what scenarios, if I'm rephrasing your question somewhat, what scenarios lead to something like that? And in retail and consumer, there would be like a couple of different scenarios. Now, as I mentioned, my focus is based on unit level economics. So I'm looking for structural change within the business. And one way that this can happen is retailers that outgrow their uh, their demand. So they open up, instead of 500 stores, they open up 700 stores, but the last 200 stores are terrible. And so the margin profile of those remaining 200 stores dilutes the whole business, and and then usually your earnings are lower and the multiple collapses because the growth story is over. That's one scenario. I'm going to leave aside fashion plays because those have their own life cycle. So, if you're a teen retailer and you've got the product right and the kids love you, these can last 5-7 years. But then if the kids move on to something else, like, you're kind of dead in the water, very difficult to continue. I have been involved in stories like that, but it's difficult. You need to be in the stores all the time. You really need to have a sense for the fashion. You need to know what the kids are buying, not buying. And what I found is that the trends can last much longer than you think they're going to. And so kind of forecasting the length of the cycle is a bit of a total guessing game. So I prefer to look for businesses that are growing from one market to a new market, that are growing too fast, that are changing their go-to-market strategy in terms of the store format, that are facing incremental competition. And I want to see that manifest in primarily in the new store metrics, which I then think will lead to a change in same store sales and change in margin performance, which will ultimately lead to much lower than expected earnings. So that's a very abstract answer to your question, but that's what I'm looking for is companies with these high multiples that where investors are paying for the growth many years into the future, and I can find a reason why I think that growth isn't going to happen or isn't going to manifest at the margin profile that the street's expecting.
I think you're the perfect guest to give us kind of a state of the union on the retail market in the US, because you said that's the market you focus on. I mean, obviously, there was this idea that brick and mortar was dead and that people were only going to buy things online. And then COVID, to some extent, accelerated the decline of certain business models. But I think maybe surprisingly to a lot of people, plenty of retail concepts are still thriving. Maybe you could give us just a state of the union of like where you see retail doing well, where you see doing poorly, and maybe you can talk a little bit about mall versus off mall, just within that
Sure.
response to give us a sense of kind of your view of the world right now.
Well, it's certainly the case that most retail formats have had to adapt or they've gone away over the last decade as a result of what's happened with e-commerce. There are some formats where e-commerce penetration remains quite low. For example, grocery, food retail, it's still quite low. I think it's in below 10%. If you go to certain discount retailers, for example, TJX and Ross, excellent companies, they don't do any e-commerce at all and hasn't really affected their business model that we can see. Other things are more impacted, but you mentioned COVID, and I think many large retailers were slow to recognize what was happening with e-commerce if we go back into the past. Then they became more concerned with investing in omni-channel and e-commerce related capabilities. But the one thing that came out of COVID that really changed the game for a lot of these companies, which is now kind of reset the dynamic, is buy online, pick up at store. So, and if we look, two examples of this are Target and Dick's Sporting Goods. And both of these companies had been building or had very advanced e-commerce capabilities. But then within COVID, they turned on or amplified this buy online pickup in the parking lot. So there's buy online pickup in store, but there's also we can bring it out to you in the parking lot or drive through. And then when people were afraid to go into stores, this capability became really in demand. And so Target saw huge increases in customers buying things on their phone and then driving by the store on their way home. And then the employees would come out with a shopping cart and put it right into your trunk or what have you. And also Dick's Sporting Goods similarly was doing that. So why did that kind of reset the playing field? Because Amazon can't do that. They don't have stores. So they need to deliver to your home or your office. And there's also some people that live in markets or places where they're not comfortable having product delivered to their doorstep. I happen to grow up in Wisconsin, and I think where I live right now or this week, it was minus 12. You don't want things delivered to your doorstep when it's minus 12 if it's groceries. Like if you come home a couple hours later, like it's no good anymore. So that just doesn't work. It's much better to pick that up on your way home and to know that it's going to be in a secure climate controlled environment the whole way home. Some people don't live in places where their front doorstep is secure. If you live in New York City, you don't have a doorman to collect your items for you. You can't have Amazon dropping off all sorts of boxes on your front doorstep. So you had an added convenience element, which you get the item the same day. You had increased security. And then the retailers also benefited because what they found is that once the COVID restrictions started to release, customers would then come into the store. So they would buy the items in advance to be assured that they would have what they needed when they got there. And then upon arrival, they would still come into the store and make additional purchases. And so I feel like this has created a response to e-commerce only retailers because they can't really do that. So yeah, maybe you have a lower cost structure and you can get things really fast, same day, next day. And certainly Walmart, Home Depot, Amazon, all of these sophisticated companies with broad distribution center networks are oriented to getting to you things as quickly as possible. But on your way home from work, where you can also pick up other stuff, is a service you can only provide if you have a nationwide network of stores and a sophisticated e-commerce interface that customers can take advantage of.
And the disruption of brick and mortar by e-commerce. I mean, I think this is not a new concept. And obviously the response by the brick and mortar retailers has been, in certain cases, a good offset to encroachment by e-com only. Where do you think we are in terms of the evolution of brick and mortar retailers and the continued risk of disruption from e-com for most of the companies that you follow?
So it's kind of come full circle. So the original wave of disruption, where the companies that were too slow adapting have gone away, like that's finished. So at this point, if you're still around, you've found some way to coexist with this competition from an e-commerce perspective. More in more recent years, starting before COVID, actually, you had the digital native brands going the other direction. So you had brands that started on Instagram or started as digital only, starting to open up stores. I'm thinking of like Warby Parker or Untuckit or some of these other companies. And a lot of times what they would do is open showrooms. So they wouldn't necessarily have the inventory at the store, but they wanted still to have a place where customers could come and try the product out and take selfies. And they were very, Instagram oriented. And so that disruption is still happening. These little digitally native brands, because consumers are always interested in novelty, and people are trying to find new ways to bring products to consumers at lower prices than they paid in the past. So I think that's kind of the current wave, if you will. I don't really know what the next wave is going to be, but for sure there's going to always be evolution. There's always going to be new things coming to market. I don't know if we have a business model transformation that's kind of on the cusp of happening, but omni-channel is here to stay. Integrated commerce over social media platforms. These are the things that are kind of developing that existing retailers are going to have to adapt to and provide service to their customer, depending on what category they're in.
And restaurants have also had to evolve a little bit. COVID was an accelerator. Delivery has to be more important now. I think people pick up from stores now more than they did before as a result of COVID. How would you say the publicly traded restaurants have navigated COVID and the emerging importance of delivery?
Well, it was hard. It was hard for restaurants, right? So a lot of them were shut down, especially the casual diners or full service diners. And many of them went to delivery only or off premise only, as we say. And off premise exploded. So you needed to have some capability of off premise already in place. But certainly the restaurants rushed to develop this, to get new packaging, to sign deals with the delivery services like Uber Eats. But then coming out of COVID, the challenge for that industry was significant inflation in labor costs. So of the likes that they'd really never seen before. So it was in labor costs, but also in commodities, because there weren't enough delivery guys to get the products from the farms to the distributors, and so costs just went up across the system. And then the response from the industry was to significant increase in prices to try to offset this. While they were doing that, one of the places where they added or piled on more increased costs was delivery and off-premise. And so coming out of COVID, the off-premise channel became more expensive relative to eating in the store. So we're still in a process right now, here in early 2024, of unwinding this outsized off-premise benefit. You still have traffic to the stores going in, increasing, or to the restaurants, but being more than offset by declines in off-premise. And so what we haven't reached yet is an equilibrium where that's kind of where they'll start to move in lockstep again. Overall industry traffic remains quite difficult. It's negative and continues to be negative, and it's been negative. It was negative before COVID, and it's compounding negative for a lot of restaurant and quick service operators. And that could be because of some cohorts of consumers at the lower income trading out, buying more food at home. It's unclear. There was an estimate that perhaps 100,000 restaurants closed during COVID, and this was supposed to aid traffic to the remaining group, but I don't think we ever really saw that. So I'm not sure either that first number wasn't right, or what kind of restaurants those were. They just weren't restaurants that competed with the public restaurants that we look at. There's a lot of potential explanations. But so off-premise, I think, is here to stay. It's not growing really for restaurants at the moment, but at some point, maybe later this year, it will start to reach kind of whatever its new normal level is.
So, John, there are some incredible examples of retail compounders. Home Depot, Walmart, and even newer players such as Lululemon come to mind. I know you look for that really granular data on incremental returns on invested capital. But if you just take a step back from that, what is a profile of a company that has a potential to be a compounder within the brick and mortar space?
So it's a great question. And so now with retrospect, you can look back at all the really amazing compounders that I failed to invest in myself, like, 20 years ago, that have gone up like a crazy amount. So for example, today I was just looking at Deckers, which is the company that owns the UGG brand and the Hoka brand and Teva. I originally met the company, the founder who bought the Teva brand from a whitewater rafter who had invented it in Colorado or something of that nature. And I think it was a 400 or 500 million market cap business back in 1999. And I was horrified today to see that it's now worth $19 billion. And that I don't think I've ever owned the stock. So what was great about that company that I missed? In this particular case, it was a fantastic brand that had the ability to grow. Another one that I encountered ages ago that didn't buy was Tractor Supply. Tractor Supply was a well-run retailer that addressed a need of a particular consumer segment that wasn't really being served by the other retailers, the other competition. And so they were kind of able to grow kind of in a stealthy way and take share over a very long period of time with excellent execution. Home Depot and Lowe's have been dominant for so long. I feel like it's hard to talk about those guys and what's made them successful, other than to point out that it's kind of a duopoly. There's only so much room for home improvement retailers. You can't really open more of them. It was somewhat immune to e-commerce because of the heavy and bulky nature of the products and the fact that a lot of contractors shop there and get their supplies there, and you can't wait for things to be delivered if you're on a work site. So those two factors, the size of the items, the cost of shipping them, together with the immediate need for home improvement related things, insulated those business from e-commerce. Um, Lululemon is a story of a vertically integrated retailer with a brand that found a that was innovative and found a space to delight its customer and remained innovative. So I would say among the characteristics I look for, like innovative with products. That's also true in restaurants. Always finding new things to excite the customer. So Starbucks would be an excellent example of that. I would say Starbucks has the greatest product innovation engine within the QSR space. They always have new items in the store on the menu every time you go in there. And I think that drives repeat visits. So innovation, financial model, willingness to reinvest back in the business, and excellent execution. All of those things together are the characteristics of businesses that can grow over time and feed capital back into their existing store format.
Just about any growing retailer you look at will highlight a total potential store base. In my experience, companies are rarely able to get anywhere near those aggressive targets. Obviously, it's a good thing if you buy a company with 100 stores and they have 500 productive boxes 5 years later. That's a good thing. But how do you get a sense for how realistic the numbers a company puts out are?
Okay, well, that's a great question. So it again, like all retailers, can depend a bit on the category. So if you're a mall-based retailer, we know how many malls there are in the US. They're not building more malls, right? So, and generally there's considered to be 300 A malls. And so if you're a concept that needs a higher income consumer, there's a limited number of places that you can be. If you're a more democratic product category, if we look at, say, Target, I think has 2,000 stores. I might be wrong about that, but they're selling stuff that everyone needs. They're aiming at a middle income family. Obviously, they draw from both higher income and lower income groups as well. So you can have a lot of those stores. Let's take the dollar stores as an example. So I started following Dollar Tree in 2001 and Dollar General. And the question I was most frequently asked in 2001 and 2002 is, how much faster, how much bigger can these chains be? Can they really keep growing? Dollar General has been opening 1,000 stores per year for the last 5 years or something of that nature. So they just keep growing these bigger and bigger than you could ever possibly imagine. Maybe they are finally coming up to the point where they're reaching some saturation. But I've seen both sides where they just keep moving the goalposts further and further as they open more stores, and it seems to work out. And I've seen other cases where they don't get close to their potential white space, if you will. I think the answer is, how unique is the concept? Who is the target customer? And where are they taking share and dollars from? Another example, maybe a little quirky, is a company called Build-A-Bear. They do custom-made stuffed animals for children. Probably most people know this concept. It's not the kind of thing you need in every mall. It's something that people would actually drive to for a special occasion, for a birthday party, for a corporate event, for what have you. You don't go back 5 times per year. You go once per year, twice per year. So opening too many stores, opening stores in adjacent malls did not work for them. They opened too many stores. So that concept probably has saturation in the 200 location, 250 in that zone. Other things that are really convenience driven, like coffee in the morning, you can have a lot of those because everyone wants coffee. It needs to be hot. And so that's why Starbucks has so many locations. So the answer to your question is, it depends. But again, unit economics is an analysis where you can try to find out if a company's open too many stores, you can see a little bit of a clue. Another good example is Chico's. So Chico's, if you can, which is a women's apparel retailer, was one of the hottest stocks in the entire market in the 10 years leading up to, I think, around 2004. And they opened, 500 excellent stores. The problem was they opened 600 stores, and the stock was trading at 4 times revenues. I think it went from the mid 40s to 2 during the financial crisis, because they overexpanded. So you have to really pay attention. Each one's a little different. Some concepts can just keep growing, others hit the wall.
And when companies do end up having to close stores, are there some common things that companies do wrong in your estimation when they develop their footprints and they build out their store base? How is it that these companies get to the point where they have 100 too many stores?
So it's a combination of needing to serve Wall Street's growth expectations and misunderstanding their demand, their customer. Gap is a good example of that. I think when I moved to Manhattan in 1996, there was like a Gap location on every block, and they ended up closing like a huge number of them. And look, Wall Street pays for growth. So management teams feel like they have to deliver that unit growth, that they can't do the right thing and deliver the bad news that, hey, we're at the edge here. We really shouldn't open up more stores. You get punished for that from a stock multiple standpoint. So external pressure and internal failure to recognize what's going on.
Are there some smaller retailers? Because you said earlier that the best thing in the world would be to find the next Home Depot or Walmart or Costco. Are there some small retailers that are on your radar that maybe have an interesting product, seem to be innovative, look like their store base is nowhere near penetrated? I just love to hear some not predictions, but some companies that people in the investment community might keep on their radar to see if they have the potential to be, I don't know if there's going to be another Costco, but something a lot larger than they are now.
I'll give you one example of a company that I've only recently started doing some work on. I haven't fully analyzed it, but it's probably a name that fewer people know about, which is something called Savers Value Village. You heard of this company? Okay, so they're a for-profit thrift store. Okay, so they compete with the Salvation Army and Goodwill. They have 300 locations. They've been in existence for 90 years. And what's interesting about it, among the things that are interesting about it, is that while you might think, hey, they're competing with nonprofit retailers that don't have to show any profit, that seems like a bad competitive set because you need to make a profit and they don't. But actually, I think the Goodwill and Salvation Armies, not to say anything bad about them, they run their business at break even. They don't really, they're not concerned about the store experience, about their inventory turns, about whether it's an efficient use of capital. That's not really their mission. And when you get donations of used clothing or home goods or what have you, it actually requires a expertise in managing this inflow of goods. So the product comes in and they have like a mini warehouse in the back of each store where they have to sort all of the goods to things that they're going to wholesale at break even somewhere else, things that are actually just trash, things that they need to be cleaned or fixed up and can be sold, and product that can go directly out onto the market. And that functions as a moat, a competitive moat, because it's difficult to manage and process through all that product. Then in addition to that, they turn their inventory 16 times per year with an average price point out the door at $5. They have 300 locations a day. I believe they're opening 20 to 30 locations per year. But if we look at Salvation Army and Goodwill, those chains have like 9,000 locations, 6,000 locations. So I think here we can make a really good case that 300 could be 600 or 900. It's not easy to get into this business. There's not, the competition isn't really trying to steal share from them. That's not their mission. And there are some other positives about this. For example, that, they are keeping used apparel out of landfills and they're providing product to a consumer that needs to buy things at a $5 price point. So there's kind of a feel good element to this business. Also, lastly, 16% or mid-teens EBITDA margins. So you have very high margins, fast inventory turns, lots of growth, kind of differentiated business. And one question you might ask yourself is this like TJX? Like TJX, if you go to those stores, it's kind of crazy, lots of product in these giant warehouse type stores. One of the greatest retailers out there. Has been an incredible investment. Can Savers Value Village be like that? So that's the kind of thing. So my job now is to take that concept and really calculate what is the return on invested capital each unit. Is there a change happening? Is there a ROIC cash flow story attached with this growth? And how attractive is that relative to the multiple the market's paying for the stock?
And you brought up valuation there. We haven't really talked about that. Does your approach, the return on capital and cash flow philosophy and focus, do you value companies differently than other people do? Because I think, whatever, especially in this space, there's a lot of PE and EV to EBITDA used to value companies. How is your valuation approach different at all from how traditional retail-oriented investors focus?
Well, I think, EV, EBITDA and PEs and DCFs, I mean, these are all, well, maybe not DCFs, but those first two are shortcuts to kind of get to like where should a stock be trading. So more recently, I've come up with a unit-based valuation approach where I calculate the value of the existing business and then separate out what the market is paying for the growth component. So just to repeat that, I try to estimate the cash flow from a company's existing store base, removing maintenance, CapEx, et cetera. I put a market multiple on that. And then I subtract what the EV in the market is from this no growth component. And then I say that's what the market is paying for the growth piece. That's step number one. Step number two is I estimate the value of the growth. So I take all of the anticipated store openings over the foreseeable future, let's say that's 5 years. I run a store level DCF and I say this is the future cash flows from the yet to be open stores are worth X. And then we look at how much is the market paying for the growth multiple from step one versus how much do we think the cash flow from yet to be open stores is worth in step two. And that tells us what premium the market is paying for growth. Now, normally the market pays a premium for growth. It pays more than really that growth is worth. And there could be various reasons for that. One might be that you expect the existing business to also become more profitable in the future, for example. But occasionally we can find cases where the market is not paying anything for the growth. And so those become really interesting. So now I can say, look, hey, the market you're buying the cash flow from these yet to be open stores for nothing. You're getting it for free. And if it's also a high return business, then that's something that could get really excited about, because now you've kind of quantified why the stock is undervalued relative to the future cash flows.
And do you have an example, either past or present, that fits that story that you just told, that there was a big gap between what the market was paying for the growth and what you thought the growth could be worth?
Sure. So one example is Academy Sports. And so Academy and Dick's Sporting Goods and sporting goods in general were large beneficiaries during COVID, and earnings shot up multiples higher than pre-COVID levels, which led investors to believe that these were kind of one-time earnings improvements, like a Peloton. But what the market was missing for both those businesses, in my opinion, were other structural changes happening within the market and within each business, such that even though they gave back some of that demand, they've retained vast majority of the improved profitability. So when I calculated what the market was paying for the growth option for Academy Sports, it was like negative. Like the existing business, the market was pricing the existing business as if it was over earning, and that earnings were going to be significantly lower. So you were getting the existing business at a discount, and the future stores were not even in the consideration set. Like the cash flow from the future stores, which I thought were actually quite foreseeable, like maybe they would be at different levels, but the fact that they were going to open the stores seemed not not up for dispute. You're getting all that growth for free.
I'm fascinated by the lens and the granularity you bring to this space. It certainly feels like especially relative to a generalist, but even to other industry specialists, you've developed an edge and a reason to be able to find interesting companies that other people might be underappreciating. We're going to close this podcast with a couple of questions, regarding the opportunity set. I'm curious, if we're having this conversation in 7 years, what would success look like to you for both maybe the research product and the asset management side?
Well, let's start with the asset management side. So, I mean, I'd like to grow my assets under management. It's quite small at the moment. And I want to deliver market beating returns with a very low tax implication for my clients. So I think over the 5 years I've managed so far, I've delivered, I think, no net gains, no net realized gains from a tax standpoint. And we've compounded at over 10%. Now, unfortunately, that's slightly lower than the market over that period, but very seldomly do people tell you what the after-tax compounded gain is. I know that my after-tax compounded gain is about the same as the total gain. So I want to continue to do that on a bigger client base. So look, I want to help people. You feel good when you manage money for individuals because you're helping people and you're providing a buffer for them so that they can feel confident having their money in the volatile market. And so that actually, I think, is quite satisfying. On the research side, my objective is to do the best possible research I can. And I try to market it. I'm not that great at marketing my product. There are two different skill sets, perhaps. But I'm always looking for fantastic ideas and new things to analyze. I'm wrong all the time, just like a lot of people. Sometimes my skepticism gets in the way of seeing something that's really great, and I focus on something that's not going, which they're able to overcome. And so that gets me in trouble. So I'd like to make fewer errors. But continue to help my professional clients identify really great ideas and have an interesting differentiated viewpoint on the market.
So we'll close with a question we ask all of our manager guests. What is the most underappreciated aspect of the investment opportunity on the asset management side of Quo Vadis today?
Underappreciated?
Yeah, just like what do you think is the long-term investment opportunity that may, in giving your expertise in your specific lens, that people may not quite appreciate right now?
Well, I think in general, Wall Street, both professional investors and managers, are too short-term oriented. Now, that's not really like a revolutionary statement, but I think that it's very hard for people who work every day in finance to avoid the noise of the financial media and how that influences our thinking on businesses. So, we've gone through a very difficult 2 years where narratives around interest rates were probably the most important factor driving stocks. But really, from an investment standpoint, my focus is to try to stick to like which company is growing its earnings power, has a really attractive financial model, and is early in its growth curve, and we can buy it at an attractive price and try to focus in on that. So I feel like Wall Street's too focused on what's happening right now, where's the consumer going, and is underappreciating the long-term compounders and focusing on those. So I feel like that's where I can bring more value, is finding out what's really going to drive business value creation over time. And I would love to find more investors who are able to invest with that lens.
Great. And if people want to learn more about you, where should they go?
So I'm on quovadiscapital.com. You can find me on LinkedIn. John Zolidis is my name. Pretty easy to find if somebody wants to reach out.
Great. Well, John, thank you for sharing your unique perspectives on the retail space. It's a space where I have invested and I would say not covered myself in glory over time. So, I think I can learn a lot from the way that you approach the space. Thanks so much for being on Compounders.
My pleasure. Thanks so much for having me.
John discussed a number of securities on this podcast. I do not own any of them.